Hello, I'm Peter Towers, Managing Director of ESS Small Business. Welcome to Survival Hints for Small Medium Enterprises. Today's subject, tax incentives for early stage investors. The Early Stage Innovation Company legislation, which commenced operations from the 1st of July 2016, has introduced significant taxation benefits for investors. There's a 20% tax offset based on the amount of the investment and a capital gains tax exemption. The tax offset maximum amount is $200,000, and that's available for sophisticated investors. A sophisticated investor is someone who has net assets of $2.5 million and who has earned at least $250,000 in each of the last 2 years, and your accountant has signed a statement to that effect. A retail investor is entitled to a maximum tax offset of $10,000, but the maximum investment that a retail investor can make into an ESIC is $50,000. The capital gains tax exemption is that if the shares are held for longer than 12 months and less than 10 years, then a complete capital gains tax exemption applies on that investment. So from investors' point of view, the taxation benefits appear to be substantial. For a company to qualify that they are an early stage innovation company, they have to pass 2 out of 3 tests. The first test, which we've called the provisional test because the government didn't give a name to it, relates to whether the company has been incorporated in the last 3 or in some cases 6 years, whether the company has had assessable income of less than $200,000 last year, whether the company's expenditure was less than $1 million last year, and there is a complete ban on the company being listed on a stock exchange anywhere in the world. So if the company satisfies those tests and keeps this supporting evidence, the company has passed the first test. The second test is the gateway test, and there are 7 separate items that are considered under the gateway test, and the company can earn points for achieving satisfactory results under those subjects. And these subjects include research and development expenditure as a percentage of the total expenditure of the company, whether the company has participated in the Accelerating Commercialisation Program, whether the company has already raised $50,000 or more from arm's length investors, whether the company has already registered a patent, plant patent, innovation patent or registered design, and a couple of other items. And if the company has earned 100 points or more from those subject questions, then the company has self-assessed to be an ESIC. But very importantly, the company must have prepared full supporting evidence. It's just not a matter of ticking the box. They have to have supporting evidence that they can submit to you as an investor. Or, more importantly, I suppose from the assessment process, they've got it ready to go to the Australian Taxation Office and Oz Industry, because ultimately the ATO is the final arbitrator as to whether a company has passed the ESIC test. Now, if a company cannot pass the gateway test, it then moves into the principles-based test. And the principles-based test is looking for 5 questions to be answered in the affirmative, but with a supporting commentary to be prepared for each of those questions. And the questions basically relate to: has the company got the intention of commercialising a new product, process, service, organisational or management system that has got the ability to be scaled, has got competitive advantage, that it can be promoted and marketed beyond the local market that it's been developed in, and a couple of other questions. So that's the principles-based test. If a company is able to answer the appropriate questions and file the supporting evidence, the company is able to self-assess as an SIC. Now, these taxation advantages are not available to all investors, unfortunately. The benefits of the tax offset and the capital gains tax exemption are only available on the original shares that have been issued. The shares owned by an investor who's a widely held company, such as a public company or a subsidiary of a public company, are not able to receive these benefits, and nor is an investor that owns more than 30% equity in the early stage innovation company. So that's the background to the incentives. In my opinion, these are significantly better than what an investor obtains from investing in a company that's been incorporated under Section 708 of the Corporations Code. But that's up to your individual judgment, and obviously only companies that are active in the innovation space are going to be an early stage innovation company. So if that's the type of company you're looking for, that's the background to the assessment process. So that you can obtain better information, we're presenting a special webinar on Monday the 26th of September 2016 at 4 p.m. that is targeted at investors in an early stage innovation company. If you wish to register, please go to www.esssmallbusiness.com.au, and if you'd like to receive our special article for investors in an early stage innovation company whilst you're there registering for the webinar, or if you wish you could go there separately just to get the paper, please indicate that you'd like to receive the article and we will forward that to you. Good luck with your investment in early stage innovation companies. Have a wonderful day. Goodbye.